Alright guys, so we are moving closer towards oblivion. We are moving dangerously close to a bigger energy crisis. Russia has unleashed hell on Ukraine's energy grid. We also have Iran on the brink of war. The global economy is at the edge of financial Armageddon. All it takes is for one pin to drop and inflation will fly to the moon again. And I think we all saw this coming. When Ukraine decided to attack the Russian refineries, it signaled a deadly evolution of the war. There are no limits now. It's not just military targets at risk, but energy infrastructure seems to be fair game. Russia has destroyed the largest power plant in Ukraine's Kiev region. Putin rained down missiles and flattened the biggest plant in the area. 100% of power generation has been lost. And if you add this to the loss of the Zaporozhye nuclear plant, Ukraine has lost a lot of power capacity. The energy company has lost 80% of their total generation. And this means Ukraine's energy grid is down by at least 16% in total. The strikes expose quite a few things. It shows that Ukraine's air defenses aren't as robust as they claim. Aid from the West is also drying up. There just isn't enough ammunition to counter the Russian strikes. But the situation just got worse. Energy prices around the world have escalated fast, and we might be hitting oil at $100 a barrel very soon. Russia has smashed two Ukrainian gas storages, and these are facilities linked to the Eurozone's own gas network. If the attacks continue to hit home, Ukraine could be cut away from the entire gas supply from Europe. That will lead to a total collapse of the energy grid in Ukraine. They will be essentially running on fumes. Striking the Russian refineries probably wasn't a great idea. It likely gave Moscow carte blanche, a good excuse to attack the Ukrainian energy grid in return. And here's where things get sticky. Ukraine has the most storage capacity than any country in Western Europe. Companies have stored around 2.5 billion cubic meters of gas in Ukraine last year. So just imagine if Russia strikes the upstream facilities of the storages. If the pipes transporting the gas from the west to Ukraine and back and forth gets destroyed, this will be an absolute disaster on so many levels. Now, firstly, this will cut away Western gas reserves. They will get stranded in Ukraine indefinitely. There's no way to transport the gas back to Europe, and this will also affect the economy of Kiev, which is very fragile. We have gas traders like Trafigura and Shell storing their excess volumes in Ukrainian storage sites, and the company expects this volume to climb to 4 billion cubic meters in 2024 this year. By hammering away at the storage sites, Russia is going to hit Ukraine's commercial revenue as well, at least what's left of it, and this pushes their economy to the brink. And for Europe, these strikes are pushing Europe's gas prices even higher. Just within a day, gas futures rose by almost 10%. And this is going to worsen Europe's energy situation. This will push up inflation, worsen the manufacturing crisis, and destroy consumer spending even further. Not a very good situation to be in. Europe was enjoying quite a few months of declining gas prices, so this could come as a complete shock. It isn't just a European crisis. If gas prices spike high enough, it will make producers around the world sell more to Europe to lock in their profits. Exporters like the US will divert supply away from domestic markets, and even Asia, they'll divert them all the way towards the EU. So prices across the board will definitely go up. European gas prices through next year rise on persistent risk. The problem with EU gas prices is how reactive they are to any supply disruption. Any supply curbs has the potential to cause a massive spike up. If we look at Europe's gas imports, it's very apparent why a supply disruption can spike energy prices to the moon. Before the war, Europe was importing over 40 billion cubic meters of gas every quarter from Russia alone. Everything in red color is from Russia, either directly or indirectly, and this includes supply from the Nord Stream, Yamal, Ukraine Transit, and Turk Stream pipelines. But because Nord Stream blew up and all the sanctions happened, Russian supply has dropped to only 14 billion today. Access to cheap pipeline gas is now gone. A huge amount of gas today comes from LNG, and this is the most expensive type of gas, much more than the pipeline supply. Almost 40% comes from liquefied gas, which ironically includes Russian LNG. So if a disruption happens, let's say the Ukrainian transit pipeline gets destroyed, it will be a disaster. The only replacement left will be liquefied gas on a ship from halfway around the world, and this won't be cheap at all. Europe will have to scramble to call the US or Qatar to bring in new emergency supplies, and the producers will be happy to charge sky-high prices. It will dig the EU into further debt and cause inflation to reignite. And that's why the destruction of any gas supplies or disruption can cause prices to spike more than normal. Europe is not energy independent like the Middle East or the US at all. Russia targeting Ukrainian gas storage is enough to send prices up. In the latest update, because of the Russian strikes, prices have moved up, and that's the black line you see here. Gas futures are up by 10%, hitting peaks of nearly 35 euros per megawatt hour during the colder months, and it's going to cost more in 2024 and 2025. Europe's supply is now more expensive than last winter. So warfare and economics are tightly intertwined. The Russian strikes could spark a new energy crisis again, so the risk is very real here. This will complicate the ECB's inflation fight. Even though the EU inflation is trending down to 2%, Lagarde still holding rates at 4%. Rates in the EU hasn't changed at all since September last year. And this tells us how fragile the situation truly is. If things escalate between Russia and Ukraine, a new spike in inflation could be on the cards. We are getting hammered with supply side shocks one after the other. And as you'll see over the past few days, the market's already starting to crash, and this isn't going to stop anytime soon. And let's shift gears to the Middle East because another crisis is about to erupt. And if you think Russia's strikes on gas storages were bad, this has the potential to be magnitudes worse. We all remember the attacks on the Iranian embassy in Syria. It came out of nowhere and Iran's very angry. They have vowed revenge on Israel and everyone's bracing for a direct attack in a matter of days. Biden himself has pledged support in defense of Israel. So if Iran attacks Israel directly, this could drag the entire US into a direct conflict. This war could expand and really go regional. And the last thing we want is for the Middle East, the oil producer of the world, to go up in flames. It will be a humanitarian disaster, a financial apocalypse, it's economic Armageddon for the markets. And here's how crazy it's getting. Biden is asking China to tell Iran to back down, to instruct Tehran not to retaliate against Israel. Now, this is so bizarre on so many levels. China might have financial influence, but that's as far as it goes. The attacks on the embassy were so outrageous that Beijing has absolutely no say in this. According to the State Department itself, an attack on an embassy is considered an attack on the country it represents, so it's not a surprise that Iran's taking this rather seriously. Even if Iran doesn't attack directly, the entire Middle East is filled with jihad proxies. This map alone shows us how much influence Tehran has in the region. There's Hezbollah in Lebanon, there's the Houthis in Yemen, and the Red Sea is still on fire. If countries like Saudi Arabia gets dragged in or the Strait of Hormuz gets implicated, then it's all over for the global economy. There's a reason why the market had a big sell-off, is a big reason why gold has flown to 2400 and bonds are starting to rally again. Safe haven demand is rising because fear is spreading very fast. Wall Street's fear gauge has spiked to the highest level in 2024. Just after the October 7 attacks, fear went parabolic, hitting a crazy high. And look where we are today. The VIX or volatility index is heading up again. And this is the end of the world index in financial markets. It measures the level of volatility. The harder this spikes, the greater the chance of a total market collapse. The world knows the economy is running on fumes. It is powered by deficit spending. And all it takes is for a serious inflation shock to send this house of cards crashing down. Now, will Iran take the bait and hit Israel? I have no idea, but if they do, it's likely the Americans will get dragged into this horrible conflict. And it's rather crazy what's happening in the White House now. Biden just warned Iran with a single word, don't. How is that for effective communication? It sounds more like a threat. Shouldn't there be serious dialogue? His ironclad commitment to Israel might be tested real soon as well. If Iran attacks and the US retaliates, this will escalate the Middle East war to unthinkable levels. But if it doesn't, then the US will look weak. Either way, Biden has sandwiched the US in an untenable situation. The only way out now is for Iran to rein themselves back in and to back down. But will they? There's a reason why gold has surpassed $2,400. It's a new historic high. The geopolitical risks are extreme. Inflation is still a problem and the markets are on the edge of collapse. So investors are running to a safe haven asset. The price of gold going up so fast isn't a good thing. It either signals a currency collapse or the world spiraling into chaos. Unfortunately, it looks like we have elements of both today. The problem once again lies with higher oil prices. When crude goes higher, it unleashes a ton of problems in the global economy, especially when we have two hot wars going on. And as we speak, the price of Brent crude is over $90. In fact, it's almost 92, heading closer towards 100. We are nearly back to the levels when the Middle East conflict started. A higher oil price is kryptonite for the world today. It keeps rates higher for longer, it pushes inflation higher, inflation that trickles down to everything else. Sure, there might be a lag effect. It could take a few more months for prices to reflect all the higher inflation. But the longer oil stays above $80 or $90, the CPI print is going to stay hot. US inflation is already reflecting this. If you take away energy and food and just focus on the core, inflation is getting really sticky. The blue bar shows a consistent rise in inflation month after month. Prices have increased by nearly 0.5% for a straight quarter. The red line, which is CPI for services, also reflects prices heading higher. If we overlay the price of crude, we can see a clear risk developing. Oil prices are progressively getting higher, and in April, we are at $91 a barrel. And this will feed into next month's CPI print. The rebound in inflation isn't over yet. And that's how dangerous higher crude prices are. It pushes the cost of everything up. It makes people poorer and it crushes global trade. If we look at the import-export numbers of the biggest economies, things are looking good. The latest numbers from the US and China are out, and it's telling us that global trade is winding down and consumers are in big trouble. In March, US export prices fell by 1.4% versus a year back. Exports are suffering. Global consumers are paying less for US exports because people are simply broke. This isn't a good sign. Import prices to the US increased by 0.4%, the majority of which comes from higher energy prices. Imported fuel rose by 4.7%, petroleum is up by 6% as well. Sure, natural gas import prices dropped, but the US is a net exporter, so that doesn't impact the overall figure much. In summary, the biggest economy in the world is exporting less and paying more for their imports, and this is bad news. China's export values fall sharply as the demand for goods weakens. And here's how important this piece of data truly is. China exports deflation to the world. They have a robust manufacturing supply chain so they can stay competitive. Beijing is the largest trading partner to over 100 countries. However, exports shrank by 7.5% and imports are down by almost 2%. China is exporting less to the world in dollar terms. A portion of the decline is thanks to lower prices. China's reducing the price tag to grab more market share. But a 7.5% drop signals weak demand across the world. People just aren't buying stuff even though prices are cheap. The global consumer is going broke. China's falling imports also show Beijing is consuming fewer products from the world, so don't expect China to save the global economy either. The longer inflation lingers, this will be a very big problem. The weight of high interest rates is also crushing the average consumer. The Chinese economic numbers show consumption is collapsing. And if Russia escalates further or Iran decides to attack, it's game over for oil prices. And here's how serious this threat is. The US Navy is moving their warships into position in case of an Iranian attack. They are getting ready for retaliation on an epic scale. We are this close to a bigger regional war, and if things explode, what we had last year will look like a cakewalk, a walk in a park. Gold could fly to the moon, oil will easily break $100, and the stock market might collapse very hard. So hang tight, guys. We should all pray for peace, but it's time to prepare for the unthinkable. But as always, let me know what you think. Will Iran launch an attack and will global consumption continue to crash further? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these insane times.